Chipotle, the burrito giant many of us love, just got rocked. Its stock crashed over 10% after announcing some seriously disappointing numbers and slashing its sales forecast for the whole year. This isn't just a bad quarter, it's a stunning reversal that has Wall Street asking if the once invincible burrito empire is finally hitting a wall. We're talking billions of dollars wiped off its value in an instant. This could be a temporary setback, or it could signal something much deeper. I'm going to break down exactly what happened, why consumers are pulling back, and what Chipotle is planning next. Plus, I'll reveal the absolutely critical trend among the biggest investors that could shape Chipotle's future. You'll want to hear that. It's coming at the very end of this video. All right, let's get straight to the numbers. Chipotle just released its second quarter financial report, and it wasn't pretty. The company's revenue came in at about $3.1 billion. That sounds like a lot, but it actually missed what Wall Street expected by about $50 million. Industry experts were hoping for closer to $3.1 billion. This is a big deal because while revenue did grow 3% from last year, it's a sharp slowdown compared to its impressive average yearly growth rate of over 14% for the past 6 years. Their adjusted profit per share, about 33 cents, did hit the analyst target, but don't let that fool you. The real kicker was their same-store sales, which is basically the sales at restaurants open for at least a year. These sales plummeted 4% during the quarter. To give you some context, last quarter, they only dropped by less than 1%, and analysts were expecting only about a 3% decline this time. This 4% fall means fewer people are showing up to buy burritos, and that's a major problem for a fast casual chain. Customer visits, or transactions, specifically dropped by nearly 5%. This news sent Chipotle's stock price into a tailspin, with shares falling over 10% in after-hours trading and into Thursday. This marks one of the worst single-day percentage losses for Chipotle since 2017. For context, the stock is already down over 20% since the beginning of the year. The company's total value, or market cap, now sits at around $70.6 billion, down significantly from its peak. You're looking at a serious slide from a high of over $66 in December of last year. Now, why is this happening? According to Chipotle CEO Scott Boatwright, it boils down to American consumers pulling back their spending habits. He explicitly stated that people are worried about the economy and they're starting to count their pennies instead of dining out as much. This is particularly true for lower-income customers who are actively searching for more affordable meal options. When budgets get tight, a few extra on a burrito bowl can make a big difference. It's not just consumer sentiment. Chipotle also pointed to rising costs, partly due to government tariffs. Tariffs are basically taxes on imported goods, and they're impacting the cost of some key ingredients, pushing up the overall cost of making your favorite burrito. While Chipotle has tried to offset some of these costs with small menu price increases, they can't raise prices too much without scaring away even more customers. Adding to the woes, some reports suggest the restaurant experience itself might be faltering. We're talking about things like customer service, how clean the restaurants are, and even the consistency of the food quality. If the experience isn't top-notch and prices are going up, that's a tough sell. This isn't an isolated incident either. The broader fast food industry is seeing similar trends with a general decrease in traffic across the board. It's like a beloved sports team that suddenly can't connect with its fans. The energy just isn't there anymore. Now, the big question is, what's next for Chipotle? And can they turn this around? Management has drastically cut their outlook for the entire year. They now expect full-year same-store sales to be about flat. This is a significant downgrade from their earlier forecast of low single-digit growth, which was already lower than what they first projected at the start of the year. This marks the second time in a row they've had to lower their expectations, sending a clear message to investors: things are tougher than anticipated. Despite the current challenges, Chipotle is still charging ahead with its aggressive expansion plans. They intend to open between 315 and 345 new restaurants in 2025. A key part of the strategy is the Chipotle lane, their drive-through lane specifically for picking up digital orders. They plan for over 80% of new locations to have one. In the last quarter alone, they opened 61 new restaurants, with 47 of them featuring a Chipotle lane. The CEO, Scott Boatwright, remains optimistic in the long term, stating he believes the company can eventually return to mid-single digit same-store sales growth and achieve average sales of $4 million per restaurant. But Wall Street analysts are clearly torn. The consensus rating for Chipotle stock is still a moderate buy, with an average price target hovering around $62. A price target is what analysts predict the stock will be worth in about a year. This suggests a potential upside of around 16% from current levels. But it's worth noting that many of these analysts have been reducing their price targets following this earnings report. For example, JP Morgan cut its target from $54 to $52, and Royal Bank of Canada went from $60 to $55. Even those who maintain a buy rating are becoming more conservative. It's like watching a tightrope walker. They might still be on the rope, but they're definitely swaying a bit more than usual. And here's that critical insight I promised you that big investors are closely watching. When a company hits a rough patch, one of the first things savvy investors check is what insiders, the company's own executives, and institutional investors, the massive hedge funds and banks, are doing with their shares. The picture here is mixed, but leans concerning. Chipotle's chief legal officer, Roger Theodoros, recently sold over 113,000 shares, cutting his ownership by more than half. Other top executives have also offloaded shares, with one executive selling almost $9.8 million worth of stock in multiple transactions. This insider selling often signals that those closest to the company might see limited upside or even potential downsides in the near future. Even in Congress, where some members have recently bought Chipotle stock, a prominent senator sold off a significant chunk of his shares. But the bigger institutional players show a more complex dynamic. These large funds collectively own over 91% of Chipotle stock, while some, like Sauder's financial advisors, significantly reduced their stake by about 31%. Others have been adding to their positions. Bank Julius Baer, for instance, boosted its holdings by over 200%, acquiring more than 26,000 additional shares. Los Angeles Capital Management also dramatically increased their position, adding over 849,000 shares to their portfolio. So while some big institutions are showing caution, others are doubling down, perhaps seeing this dip as a buying opportunity for the long term. This situation puts Chipotle in a crucial position. It's like a high-performance race car that just had a flat tire during a crucial lap. The team knows what needs to be fixed, but the real question is how quickly they can get back to top speed. The company is betting on new restaurants and marketing to fuel a comeback, but with falling same-store sales and consumer spending concerns, they need to show solid results soon. Is this just a temporary pit stop or a sign of deeper engine trouble? Only time and the next few earnings reports will tell if Chipotle can regain its momentum and justify its historically high stock valuation. The takeaway is this. Chipotle needs to prove it can consistently bring customers back and show growth in its existing restaurants. It's a bumpy road ahead, and while some big money is betting on a recovery, others are heading for the exits. That's why you need to stay informed. And that wraps up our close look at Chipotle's latest earnings roller coaster. If you found this breakdown helpful, do me a favor and smash that like button. It really helps the channel grow. And if you want to stay ahead of the game with direct, no-nonsense financial insights like this every day, make sure you subscribe. Don't forget to hit that bell icon so you get notified every time we drop a new video. Thanks for tuning in, and I'll see you in the next one.